Everybody wonders, what the heck just happened to real estate? I bet you're wondering that too. Well, today we're going to talk about the market cycles and what we have seen over the last 27 years that I've been involved in real estate. My name is Shannon Robnett. I'm a real estate investor, speaker, and coach, second-generation builder-developer, and fourth-generation realtor. I know that's a lot, but I've been involved in the business for a long time. Here's the thing. Real estate market cycles are very apparent and they're brief. If we look at it, we go through different cycles. We go through the expansion cycle, the peak of the cycle, then the recession, which is usually brought on by fear and or prices continuing to go skyward when things can't continue to sustain. Then we go through the trough or the depression, and then the cycle starts all over again with the recovery that leads to an expansion, that leads to a peak, that leads to a recession. And that's why over the last 18 to 24 months, we've seen prices come down. Fear has taken hold. We've also seen a lot of people that have been in the business for a long time find it harder and harder to make deals happen over the last 3 years as things shot through the roof. But I'm going to break down each one of these market indicators and help you understand them, because the more sophisticated and educated you are as an investor, the more confident you will become that you're making the right decision and be on a track to create generational wealth. Let's talk about the expansion portion of the cycle. This is where the market is booming. Let's go back to 2018. The market was strong in 17, but it really started to take off in 18. Then 19 happened with COVID. We saw a little bit of a recession that led to some depression, but after that it took off again and it began to climb because supply was not there like it had been in the past. A lot of this comes along because the consumer mindset and the consumer actions drive things in the market, and everybody's got FOMO, fear of missing out. The last thing you want to be doing is buying something because it's the last one on the shelf. You want to make sure that your decisions are educated and they're very well thought out and they have a reality and a basis in real numbers. The second portion of the cycle is the peak. So when you hit the peak, it's when prices have been driven by a lot of different factors, but a lot of it has to do with people getting in and the market continuing to expand, and then you reach the point of no return, the point that it can't really go any higher in this particular cycle. When you combine interest rates, you combine mortgage with that, you combine rents with that, all of that happens, and you get to a place where people just can't believe that they're going to go higher. I think we've seen the peak about 18 months ago, 12 months ago at the latest in our markets, and we've started to head into the recession. The recession is brought on by a couple of different factors, and that has a lot to do with our oversupply. We haven't really reached a portion of oversupply in this particular market, but it's when we start to see there become a stagnation in the pricing. Things are just not continuing to increase. There's very little demand for the new product at the higher price. And then you really notice it as the market begins a downturn and the supply and demand shift takes place. Fear begins to take hold, and a lot of people start doing things that are just as illogical as the purchase that they did on the way up to nowhere. So when you look at that, a lot of what happens in these market cycles has to do with the psychology of the buyer and the seller. I'm going to sell now because I can't believe I'm going to be getting this much. You've got other people that are holding out for just $100,000 more, on and on like that. Then you roll through into the depression where prices tend to plummet, fear spirals, and in this portion of the cycle, you see the consumer mindset go, I've got to hurry up and sell this before the price drops. You know, I was just reading an article about Boise, Idaho as one of 3 markets in the nation that had experienced a 0.04% decline in sales price. 0.04. That is such a negligible amount, but it's the fear-mongering that happens in the national media. So now you have this idea that after a 67% rise in consumer pricing on housing in the last 3 years, we're now somehow hitting this recession and depression. Then you go through the trough, the market hits a low. That can be in sales volume or sales price. We're definitely seeing prices come down a bit, but in the overall trajectory, we are way ahead of where we should be for a 5-year cycle. But what really happens there is consumer confidence is gone. Consumer ability to purchase is gone. In our case right now, it has everything to do with the fact that mortgage rates have gone up and making just your basic housing affordable to people that could have very easily afforded it 24 months ago. Before I go into the last cycle of recovery, take a minute, like and subscribe to this channel. We want to hear from you and know more about the content you want so that we can create the value that you'd like to receive from this channel. Let's talk about the recovery portion of the cycle. The market begins to take a turn for the better, confidence begins to build. What is now happening today becomes normalized. When you see that happen, you start to see people get back in or get in for the first time. You start to see the consumer mindset go, well, I guess it's not going to be that bad. But a lot of people wait through this depression into the bottom of the cycle and catch it midway through the recovery, which is again the start of the next cycle, and they've hesitated too long. They don't want to catch a falling knife. They want to make sure that they get at the bottom, and timing the market, guys, is never something that's easy to do and not something I would tell you is a good idea. If the deal pencils, the deal is worth doing because, like they say in real estate all the time, date the rate, marry the property. It's important to understand these cycles to make your best business decisions, not because you necessarily can't buy something in a recession or in the depression or at the peak even. They just have to make sense, and you need to know where in the cycle you're at so that you're psychologically ready for what's going to happen next. It's always best to buy during the trough or the depression, at least buy it during the recovery phase when prices are low, and sell it during the expansion and the peak when prices are high. Obviously, that's the perfect scenario. A lot of times it's okay to hold during the peak, even if you bought at the very top of the market, and wait for the price to recover. This is especially easy if your property cash flows. Buy during the recession phase, that's an excellent plan because things are headed down. You're going to be able to lock in some great things and ride this out as long as there's cash flow. I've got things that I've owned for a long time. I've got things that I regret selling, but there's a property that I held on right through the peak. It's lost probably 8% in market value right now if I were to sell it today. But I tell you what, that property cash flows, and I'm really glad I hung on to it because during the upcoming depression, downturn, recovery, I'm going to be receiving cash flow on it. And that's the goal of real estate, is to get your business plan to execute. I want to encourage you guys to learn more about real estate market cycles so that you can use them to your advantage when you're in the deal. When you're looking at what's happening in the market, you're not just going with what you see immediately. You understand what's coming next. You can look at your business plan and see if that's going to work for you. Guys, thanks for watching this all the way to the end. If you guys would subscribe to this channel and check out our other videos, we'd sure appreciate it.